Welcome to the deep dive. Today, we're trying to unlock what can feel like a secret language, right? Business accounting.
Yeah, it sounds intimidating sometimes.
It really can. But think of this as maybe a foundational boot camp. We want to give you that aha moment where it all just clicks.
Definitely.
We're going to take a journey from, understanding just one simple financial event all the way to seeing how a company's whole financial picture starts to come together.
And that's so crucial. Accounting knowledge is really cumulative. It's like building blocks or math,
Mm-hmm.
If you don't have that strong foundation, the more advanced stuff just gets overwhelming.
Right.
So our goal here in this deep dive is to build that solid foundation. Doesn't matter if you're a student, maybe a professional brushing up, or just someone curious about how businesses track their money.
Okay, great. Now, before we dive deeper, just a quick note. This deep dive is based on material from Farhat Lectures. The content, examples, explanations, they're all drawn from the great accounting resources over at farhatlectures.com. So whether you're a student, CPA candidate, or a professional, you should definitely check out the website for more support, practice questions, lectures, all that good stuff to reinforce what we talk about today. A big thank you to Professor Farhat.
Absolutely great resource.
All right, let's get into it then. Our mission today is to walk you through the essential first steps, the accounting cycle basics.
Yeah, the real walking before you run stuff in finance.
Exactly.
So we'll start with how financial events, transactions, we call them how they're analyzed. Then we'll get into the core accounting equation.
Okay.
Then try to demystify T accounts, look at how we formally record things with journal entries, and finally see how it all pulls together in what's called a trial balance.
So like the whole first phase, basically, assuming zero prior knowledge.
Exactly. This is really ground zero for understanding any company's finances.
And you'll see how these basics, they aren't just theory, right? They directly set us up for the more advanced things.
For sure. Things like adjusting entries, actually preparing the financial statements, closing entries. We'll cover those in later deep dives, building on this example. It's all connected.
Okay, so building that foundation. Where's the very first brick? What do we need to grasp first?
Well, it all starts with understanding what a transaction is. It sounds simple, but it's specific.
Okay.
In accounting, a transaction is any financial event, big or small, that affects a company's assets, liabilities, or its stockholders' equity.
So like buying supplies, paying people.
Yep. Buying supplies, paying employees, making a sale, even buying something on credit. If it impacts the company's financial position, it's a transaction.
And how do we keep track of all these different things happening? Can't just be a big list, right?
No, definitely not. That's where accounts come in. Think
Right.
of an account like a specific record or maybe a folder for one item.
Like my bank account for cash.
Exactly like that. Your bank tracks deposits and withdrawals for your cash. Businesses do the same, but they have separate accounts for cash, for supplies, inventory, accounts payable, that's money they owe, revenues, expenses, lots of them. Each one tracks increases and decreases for that specific thing.
Okay, that makes sense. Now I hear, this is where it gets really interesting, the fundamental accounting equation.
Yes, the bedrock. You absolutely have to understand this. It's
Yeah.
assets, liabilities, plus owner's equity.
Okay, break that down. Assets.
Assets are what the company owns. It's economic resources, things that provide a future benefit. So cash, accounts receivable, that's money owed to the company.
Right.
Supplies, equipment, buildings, things like that.
And liabilities.
That's what the company owes. It's obligations to others, like accounts payable, money owed for purchases, or maybe notes payable, like a bank loan. Debt, basically.
Oh, got it. And owner's equity.
Equity, sometimes called net assets or net worth, it's what's left over for the owners.
Mm-hmm.
If you took all the assets and paid off all the liabilities, the remainder is the owner's equity. It's their claim on the assets.
Well, assets equals liabilities plus owner's equity. What does that actually mean for a transaction then? How does it stay equal?
That's a great question, and it gets to the heart of it. How does it always stay in balance? The answer is what we call the dual effect.
Dual effect.
Yeah, every single transaction affects at least two accounts, always.
Yeah.
So if one side of that equation changes, say assets go up,
Uh-huh.
then either the other side, liabilities or equity, must also go up by the same amount,
Mm-hmm.
or something else on the asset side must go down by that amount. It keeps it perfectly balanced.
Oh.
That's the whole basis of double entry accounting. It means your total debits will always equal your total credits. It's a self-checking system.
Okay, debits and credits. These always sound like the magic, maybe confusing words of accounting. Can we break them down?
Let's try. They're actually simpler than they sound. At the most basic level, debit just means left and credit just means right.
Left and right. That's it.
That's literally it. We use something called a T account
Uh,
to visualize this because it looks like a capital T.
uh,
The left side is always the debit side. The right side is always the credit side, period.
Huh. Okay. So left is debit, right is credit. But how do you know if an account has like a debit balance or a credit balance?
You just look at which side has the bigger total. Simple as that. If the total debits are more than the total credits, it's a debit balance. If the credits are more, it's a credit balance.
Right.
But the really crucial part, the key to understanding, is knowing how different types of accounts normally increase or decrease. Which side makes them go up, which side makes them go down.
And I heard there's a handy way to remember this. A mnemonic.
There is. It's pretty useful. To remember which accounts increase on the debit side, the left side, just think DEA. DEA.
DEA. Okay.
E for dividends, E for expenses, and A for assets. Dividends, expenses, assets. These three increase with the debit.
So if they increase with a debit,
They must decrease with a credit, the opposite side.
makes sense. DEA. Dividends, expenses, assets increase with debit.
Exactly. And pretty much all the other major account types, liabilities, revenues, and common stock, which is part of owner's equity, they do the opposite. They increase on the credit side, the right side.
Okay. Liabilities, revenues, equity increase with credits.
Right. And decrease with debits. Grasping this relationship, DEA increasing with debits, the others increasing with credits, that is absolutely key for everything else, especially for making journal entries correctly.
Okay, so we've got a transaction, we know how it fits the equation, and we understand debits are left, credits are right, and the DEA rule. What's the actual next step? How do we record it formally?
Right. Now we get practical. That's where journal entries come in. This is the first place we officially record every transaction, chronologically, like a diary of financial events.
A financial diary. Okay.
When you make a journal entry, or journalize, you list the account or accounts being debited first. Always debit first.
Left side first.
Yep. Then you indent a little and list the account or accounts being credited, and sometimes you'll add a short note explaining what happened.
Can you give an example? Like that investment you mentioned, Adam starting his firm.
Sure. Adam invested $50,000 cash in exchange for common stock.
Yeah.
So cash, which is an asset, went up. Assets increase with a debit. So debit cash, $50,000.
Okay, debit, cash.
And common stock, which is part of equity, also went up. Equity increases with a credit. So credit common stock, $50,000. Debit cash, credit common stock, both for $50K. See? Balanced.
Ah, okay. Debits equal credits. Got it. So after we write it in this journal, this diary, what happens then?
Good question. The next step is called posting. We need to get that information from the journal entry into the individual account records.
The specific folders, like you said.
Exactly. We post to the general ledger.
Mm-hmm.
Think of the ledger as the master collection of all those individual T accounts, one for cash, one for supplies, one for common stock, etc.
Yep.
Posting just means transferring those debit and credit amounts from the journal entry to their specific T accounts in the ledger. This updates the running balance for each account.
So for Adam's investment, the $50 K debit goes to the cash T account in the ledger.
Increasing its balance, right?
And the $50 K credit goes to the common stock T account.
Increasing its balance. Now the ledger reflects that transaction for both accounts.
Let's try another one to see it flow. What if the company bought, say, $9,000 worth of computer equipment and paid cash?
Excellent. Okay, analyze it first. What happened?
Cash went down. That's an asset decreasing.
Right.
Computer equipment went up. That's another asset increasing.
Perfect. So one asset down, another asset up. The equation assets equals liabilities plus equity stays balanced because the change is all on the asset side.
Okay, so the journal entry, debit or credit?
Well, cash is an asset decreasing. Assets decrease with
Credit.
Right. So credit cash, $9,000. Computer equipment is an asset increasing. Assets increase with EBIT.
DEA rule.
Exactly. So debit computer equipment, $9,000. Journal entry. Debit computer equipment, $9K. Credit cash, $9K.
And then post those amounts. The debit to the equipment ledger account, the credit to the cash ledger account.
All right. Updating both their balances.
Okay, one more. What if Adam borrowed money, say $40,000 from a bank, signed a note payable? What up?
Well, the company gets cash. So cash, an asset, goes up. That's a debit.
Good. Hold on.
Now they owe the bank money. That's a liability, right? Notes payable.
Correct.
So notes payable goes up, liabilities increase with a credit.
Perfect. So the equation balances again. Assets went up $40 and liabilities went up $40K.
So the journal entry is debit cash, $40,000, Credit notes payable $40,000.
Precisely. And then you post those to the cash ledger and the notes payable ledger. See how we keep building those balances, transaction by transaction?
Yeah, I can see the running tally now. Okay, so we've analyzed, we've journalized, we've posted everything to the ledger accounts. What's the last piece of this sort of initial setup? The next step is to check our work, basically. We prepare something called an unadjusted trial balance.
Unadjusted trial balance. Okay. What is that?
It's simply a list of all the accounts in the ledgers. Cash, supplies, equipment, accounts payable, notes payable, common stock, revenues, expenses, all of them, and their ending balances at a specific point in time, like the end of the month.
And how's it organized?
Usually in a logical order. Assets first, then liabilities, then equity accounts like common stock and retained earnings, then maybe dividends, then revenues, and finally expenses.
Okay. And it shows the balance for each account.
Yes, and crucially, it shows whether that balance is a debit or a credit. Remember the normal balances. Assets, expenses, dividends, DEA normally have debit balances. Liabilities, equity, revenues normally have credit balances. The trial balance lists them that way.
And what's the trial part? Or the magic, as I think I called it earlier.
The magic, or the crucial check, is this. You add up all the debit balances in one column, and you add up all the credit balances in another column. And those two totals must be equal.
They have to match exactly.
Exactly. If the total debits don't equal the total credits on the trial balance, you know you've made a mistake somewhere, either in a journal entry or during posting. It's a fundamental proof that the accounting equation is still in balance after all those transactions.
Wow. Okay. That's a vital check then. But you called it unadjusted. So this isn't the final report.
No, not quite. It's a huge step, but it's unadjusted because we haven't yet made certain internal adjustments that are needed at the end of a period.
Adjustments? Like what?
Things like accounting for supplies that were used up during the month, or recognizing rent expense for the part of the prepaid rent that's now expired, or maybe recording revenue that's been earned but not yet billed. These are called adjusting entries.
Okay.
They fine-tune the accounts to get a more accurate picture of financial performance and position. And that's actually what we'll dive into in our next deep dive. Preparing those adjusting entries is the next major phase.
Got it. So the unadjusted trial balance sets the stage for those adjustments. Wow, okay. What a journey just now. From a single financial event, analyzing it with the equation, using debits and credits, putting it in the journal, posting to the ledger, and finally getting this unadjusted trial balance where everything, hopefully, balances out.
Yeah, you've just walked through the absolute core steps, how every transaction starts building that financial story of a company.
It really demystifies it quite a bit.
And remember, this knowledge is genuinely powerful. Understanding these basics isn't just for accountants or finance people.
Right.
It lets you start to decipher the health and activities of any organization. You can ask smarter questions, understand news reports better, make more informed decisions, whether it's about your own investments or your job.
Absolutely. So as everyone reflects on this deep dive, here's maybe a provocative thought to chew on. How does this strict dual effect in accounting, this idea that every transaction has balancing entries, how does that mirror the kind of interconnectedness or equilibrium we see or maybe strive for in other complex systems like, I don't know, ecosystems or even just our own personal finances?
That's a great way to think about it. The interconnectedness is key. And as you continue learning, don't forget farhatlectures.com has tons of resources, practice questions, more lectures to really build on this foundation we laid today. It's an investment in yourself, really.
Definitely worth checking out. We hope you enjoyed this deep dive into the building blocks of accounting. Until next time, keep exploring, keep learning, and stay well informed.